In Africa, we are seeing stronger resilience despite cuts in external aid and rising external shocks. This is a strong governance, leadership, and institutions help countries to respond quickly. In 2025, for example, governments raised roughly $18 billion from international capital markets. Before aid cuts in 2024, funding from USAID accounted for about one-fifth of Nigeria's health budget, but Abuja is reported to have mobilized about half of that amount to cover shortfalls. Ethiopia also introduced a new tax to cover funding previously provided by USAID, and Ghana removed caps on its national health insurance tax and allocated more funding toward health and social programs. Hello, this is Global Business Insights, where we look at the world from a business perspective and bring you news, views, and analysis that helps to get up to date on the context. The deep dive focuses on how Africa is showing better resilience to global shocks. In a recent Foreign Affairs article on how a post-aid Africa is coping, we see new analysis of two main factors in assessing resilience and capacity to ride the waves amid new external headwinds. First is the degree to which an economy is susceptible to external shocks, including geopolitical instability, supply chain disruptions, demographic pressures, energy import dependence, technological change, and climate hazards. Second is vulnerability or ability to deploy policy tools during uncertainty and depends on the strength of its domestic economy, the quality of its institutions, its physical and digital infrastructure, its population's access to electricity and social services, and its resilience to climate change. Better governed countries with strong institutions are able to reduce exposure to external shocks. Others that are relatively insulated from shocks do have some breathing room to invest in strengthening its institutions. In the Foreign Affairs article yesterday, Landry Signe, college professor and co-chair of the Regional Action Group for Africa at the World Economic Forum, presents recent research classifying states into various risk groups depending on their vulnerability and exposure. The Trailblazers group consists of 21 countries that enjoy resilient domestic resources, diverse economic frameworks, and solid institutions, which collectively help them withstand external shocks. Rwanda is currently prioritizing the improvement of its public institutions to attract more investments. Mauritius, by implementing innovative approaches such as streamlined work permits and fostering strong collaboration between the public and private sector, has turned geographic limitations into opportunities. Mauritius has also been able to reduce its susceptibility to risks by prioritizing human capital and wellness drivers of economic productivity. South Africa stands out as a prime illustration of how minimal exposure and vulnerability complement each other. Its intricate and advanced economy reduces reliance on single exports or commodities, while its robust financial systems and institutions enable the use of multiple policy strategies during periods of disruption. South Africa showed impressive resilience during the global trade shocks of 2024 and 2025. It managed to keep its currency stable and successfully redirected exports to both African and international markets. Over those 2 years, agricultural exports rose by 10%. The government also strengthened partnerships, including signing a new trade agreement with China that allows certain South African products duty-free access to Chinese markets and encourages Chinese investment. The other resilient trailblazers include African economies like Botswana, Kenya, and Egypt, which tend to exceed the World Bank's recommended 15% tax to GDP ratio and have better fiscal capacity to maintain public investment during external financing disruptions. But the recent US-Israeli assault on Iran is a source of stress to Egypt's finances by hiking energy costs, hindering exports, and pushing foreign investors to sell off treasuries. Egypt is still classified as a trailblazer in this study, with less exposure and vulnerability to shocks. But there are other countries seen as having high exposure to shocks and vulnerabilities. These face both severe external pressures and institutional limitations and are tagged as stabilizers. Major economies such as Nigeria and Ethiopia fall into this category with relatively thin fiscal buffers. But for some of these stabilizers, we have also seen swift actions and reforms that need to be sustained that came in response to aid cuts and other challenges, also showcasing exceptional adaptive capacity that emerged under pressure. Regional integration is also increasing, although the share of the continent's total trade, that is intra-African trade, remains still relatively low. Nigeria, despite noted associated risks, has, for instance, significantly increased its intra-African exports. As we see less energy import dependence, Nigeria has also halted gasoline import licenses for 2 consecutive months as regulators enforce the Petroleum Industry Act, permitting imports only if domestic supply is insufficient. According to the Nigerian Midstream and Downstream Petroleum Regulatory Authority, no licenses were issued in February or so far in March, indicating a shift towards favoring local production. Stabilizers also need basic peace and security before economic resilience strategies can take hold. Nigeria has rightly focused on monetary stabilization that has made it more attractive. For example, Nigeria received $20.93 billion in personal diaspora remittances in 2024 compared with the $3.37 billion in aid from foreign governments. Nigeria is an example of where loss of aid has had minimal effect as capital flows from other sources improved. My take is that countries still in the stabilizers group need more alertness and responsiveness given the new geopolitical shocks. For Nigeria, despite advantages in being an oil producer, the need to sustain and even step up micro-level reform execution and tighten fiscal discipline in a pre-election year cannot be overstated. To other news, the European Commission President Ursula von der Leyen says it was a strategic mistake to phase out nuclear reactors, turning its back on what she called a reliable, affordable source of low emissions power. The EU's executive arm is now pushing small modular reactors as it diversifies Europe's electricity supplies. China has also set very aggressive goals to move faster in expanding its nuclear energy print as electricity grid demand is expected to spike up. There is a much increased need for affordable, cleaner energy amid new energy security challenges associated with new artificial intelligence technology data centers and recent volatility of fossil fuel costs. On the latest on energy price volatility, Amin Nasser, CEO of Aramco, Saudi Arabian oil company, says it is ramping up an alternative pipeline to export its oil. This will not completely eliminate the bottleneck at the Strait of Hormuz, but it would ease some of the supply fears. Amid conflicting reporting and mixed messages on the situation at the Strait of Hormuz in Iran, Brent crude, the global oil benchmark, briefly fell below $80 a barrel, continuing its slide. It continues to be volatile. The US also claimed it had stopped Iranian ships planting mines to make the strait unpassable. Chevron and Shell are reported to be nearing major oil production agreements with Venezuela, marking the first such deals since the U.S. capture of President Nicolas Maduro. These deals could increase production as part of a $100 billion plan to revitalize Venezuela's oil industry after years of decline. Optimism remains that if Beijing and Washington take advantage of the present opportunity to establish a renewed relationship, they could secure their future strategic interests and contribute to greater global safety and stability. The question is whether Trump and Xi Jinping recognize that this window for adjusting their goals and approaches is brief. This will become clearer when Trump makes a state visit to Beijing from March 31 to April 2nd, 2026. The visit will focus on stabilizing U.S.-China relations and advancing discussions on trade and investment. However, at present, the trip looks more like a wild card. Conditions have not been sufficiently prepared for any significant progress in improving bilateral ties. The ongoing conflict with Iran has not diminished the willingness to engage in dialogue, indicating that both parties may be interested in de-escalating trade and technology tensions and seeking mutually beneficial solutions. Analysts concur that if Beijing and Washington continue to intensify their competition and restrict opportunities for collaborative alliances and discussions, the global environment will likely become more unstable, unequal, and hazardous. Moreover, for now, heightened mistrust and domestic political pressures could further escalate tensions, making the risks increasingly difficult to mitigate. President Xi Jinping is expected to reciprocate with a state visit to the United States later this year. Despite a war playing in the background, the AI narrative is not losing any of its steam. Meta is buying Moltbook, a social network for AI agents that launched in January for an undisclosed price. Meta also is hiring Moltbook's two co-founders to work at its superintelligence labs, for which it has spent huge sums poaching talent from rivals. Also, Oracle posted quarterly revenues of $17.2 billion, beating analysts' expectations, and also 22% higher than on the same period a year ago. Oracle also raised its revenue forecast for next year to $90 billion as it invests heavily in cloud computing infrastructure, adding that demand for its cloud services has been strong. Still on AI, OpenAI is launching its AI video generator Sora in ChatGPT Sora, which expanded OpenAI's foray into multimodal AI technologies, will compete with text-to-video tools from Meta and Alphabet's Google. On global markets, the Dow and S&P recovered from steep declines on Monday to end with their largest reversals from intraday lows since April 2025. Wall Street was still quite volatile, ending the previous session mixed, given uncertainty on how long the crisis in Iran will last and desperate assurances from the White House that the war could soon end may have had some impact. Asia Pacific markets traded higher as investors assessed the ongoing Middle East war, also as oil retreated after much talk of emergency reserve releases. US futures also higher, focused on today's consumer inflation data. Well, that's all we're able to take on this special edition of Global Business Insights. This is Bode Oshosami. Thanks for watching, and don't forget to subscribe and hit the notification button. Bye-bye.